Yeah, the question that you asked is at the topmost of ourselves and most probably all the market participants, both on the buy side as well as on the sell side, as well as for the end investors as well. This is simply because after a long time, we are seeing some correction, some meaningful correction since pandemic period. So that has got a lot of people worried. But before answering this question, I will answer this question quite directly. So let me tell you the key factors actually which we look at when looking at the market. For me personally, and for our organization as well, among the most important things are the earnings growth, earnings revision, and as well as the valuations. So maybe if I can show you some chart, but before that, let me give you the background. So most of my discussion point would be around the Nifty companies, and that's what largely we mean when we say the market. Then if you look at the history a little bit, so 2016, 17, 18, 19 and all that, in those years, the earnings revision used to be pretty weak through the year. What it means is that we used to begin the year at certain earnings expectation, and we used to end the year at a significantly lower, sometimes 5 to 10%. Let me show you one presentation here. Some charts are there, not too much actually, but okay, it will help in getting a better picture of what I'm trying to say. What you see here, this is the earnings revision history of Nifty 50 companies. And these lines, what you see, are the expected earnings of Nifty 50 companies as the time passes. So what you see is there in the beginning of 2014, expected earning for 2016 Nifty company was here, but we actually got here a significantly lower number, almost like 10 to 15% lower than what was initially expected. Same was the case in 17, 18, 19, 20 was of course the pandemic one, so obviously it was quite low on that year. These are the calendar year data. You would also recall that when this used to happen, the actual return from the market used to be pretty weak, and so the cumulative CAGR of the market return in those 4 or 5 years was into mid to high single digit only, and that was only because the actual earnings growth was weak and there was a negative earnings revision. But things began to change from 2021 onwards, and that is what we began to take for granted. So now this is the 2021 number. Here what you will realize is that although we began the year like this, in the pandemic the earnings expectation came down, but then there was a positive earnings revision and the actual number was in line with what we expected. Similarly for 22 also, so initially it was the pandemic period, so the weak earnings, then after pandemic there was a positive earnings revision. And in 23 also, there was actually no downward cut. In fact, it was a positive number. Now, fast forward to 2014 here. Now here we are beginning to see, although initially, and that is early in 2023 and early 2024, there were no earnings cut. But since June of this year, there has been almost 8-9% earnings cut here. These are consensus number. And for 2025 also the earnings cut. So what I'm trying to say here is that the earnings revision is negative and earnings cut is back. And this is what investors should take note of. The second point is that of the valuations. So after the recent correction on a 5-year basis, the Nifty PE band has come just below average, which means it's not that expensive, but please note it's only a 5-year period. If we were to look at little longer period, which gives multiple market cycles and business cycle, then the multiples are still 1 standard deviation higher. This used to be 2 standard deviation higher. So there's a bit of correction, but not enough to come back to the average level. Okay, so the short point is this. We believe that this could be an year of consolidation for the markets after the relentless rally that we have seen in the markets in the last 3 to 4 years or so, and that would be driven, that is on account of the fact that the earnings growth would be into mid to high single digit, and for 2016 as of 2026 as of now, the expected earning is still 16%, but quite likely that also would be revised downwards. So that's our view, that's our opinion. I hope it is the answer was clear. So our investment philosophy is that over medium to long term, the stock prices or the market value by and large traces that of the underlying earnings. Again, let me go back to that presentation. I have got one slide. I hope that will make sense here. This is this line. So now what you see here, this is a very long-term chart. This is for the 20 years. And here, the white line is the Nifty numbers over the last 20 years. It isn't this much. And the blue line, which almost traces that of the Nifty line, is that of the 12-month forward earnings. So we see that the market movement by and large is very similar to that of the underlying earnings. And that is also what our core philosophy is. So that's what in the answer to the previous question also, my focus was largely on looking at what the earnings could be. And so now this is over medium to long term. Now there would be periods of overvaluation and an undervaluation. So an investor can take benefit of that. And if you buy in the periods of undervaluation and sell in the overvaluation, so your returns can be maximized. But if you happen to the reverse, then your return would be negatively impacted. And since there is no one sure shot way of figuring out like what is the overvaluation and undervaluation and how long that period will continue, so we do not depend too much into that actually. So therefore, our philosophy and investment style revolves by and large around figuring out the earnings growth expectation and in the earnings revision history of that particular company and for the market. So between choosing between growth and value, which is our second part of the question, I would say that we look for the earnings growth in companies, but where there is a value, which means they are relatively cheaper, less expensive valuations. And if we look for a value company where the valuations are on the lower side, then it becomes a part of the portfolio when there is some growth associated with that particular company. So that's how we actually look for companies as an interplay of growth and value rather than growth or value. This factor that you mentioned about Trump coming to the power or the oil going up, let's add a few more macro factors like interest rates, liquidity, etc. Say they do matter, especially in the short to medium term. But I would also like to say that many times these macro factors, they do play a role, but they are not the primary source of risk or the return from that particular idea or from the market as such. Like I was explaining in the previous two questions, that our key focus continues to remain on the earnings growth forecast, and whether it's a period of under or overvaluation. But having said that, coming back to your question, is that these macro factors usually do not have got only one way of impacting the markets. There are multiple. They impact the market in multiple ways. In economics, we read ceteris paribus. That means if all things remaining equal, the impact of such and such thing would be such and such. But in reality, there's nothing is ceteris paribus. So, according to us, it's usually a futile exercise to figure out the impact of the macro on the portfolio. The way we look at this macro is that how is that going to change the earnings growth story of the underlying business? Is the underlying earnings of that or profit making possibility or the cash flow generating possibility of that business has that got diminished or has it been enhanced? There would be cases like, for instance, for the crude example that you gave, that is the crude were to go up, and if a company were to produce crude like what some of the upstream companies in India do that, then the earnings would be upgraded also. So whether the earnings is diminished or earnings is enhanced, so we look at that actually and try to compare with our original thesis, that what was the initial expectation or what was the initial valuation, and that's how we do take control of that. When it comes to the that is from the company's perspective, but your question was actually a little wider question. You also
Correct.
wanted to understand how to look at the riskiness of the portfolio. So it is important to see is this how much what part of the portfolio does depend upon any one factor, because usually there would be correlated, and the many of the stocks also and sectors will get correlated. So the way to manage is that to look at the active position in the each stock, the active positioning in each sector. So for instance, if only one or two sectors were to be negative impacted, so that part could be isolated. As a basic thumb rule, like our highest active position in a stock does not go above 400 basis points. Only in rare circumstances, exceptional circumstances, it will go higher than that. Similarly, for a sector also, usually I will not go higher than 400-500 basis point as compared to the underlying benchmark. And on the negative side as well, also the active position, that's a negative active position, will not be more than 400-500 basis points actively. So that is the way of managing the overall portfolio risk. Yeah, thank you. Very good question, especially because you're asking in the context of the medium to long-term view and the fund positioning. Yes, so that's what we actually look at. So the pillars of our portfolio would be like investment, consumption, and real estate, and parts of the financialization. Let me give a nuanced view of that. When we're looking at the investment part of the economy, then we are more positive on the companies and the sectors where the government is doing the capex, because that's what we are more positive as compared to the corporate capex, or also as compared to the household capex, which means that would be a lot more positive on the big ticket capex expenditure. We also would be more positive on the defense sectors as well. Within the investment, the infrastructure part of the economy. When it comes to consumption, we believe that the consumption is weak and will continue to remain weak for some more time. We don't see signs of picking up the consumption in a meaningful manner, especially at the lower end, or especially at the staples end. However, there are pockets of consumption, especially discretionary and aspirational consumption, which is doing pretty well and growing at a much faster pace than the nominal GDP. This is also the sector which will grow when the per capita income doubles from roughly $2,500 to $5,000. So especially when we look at 5-6 years kind of time period, we do think and believe that a discrete consumption is also the way to go. Real estate still have got some more legs to go. We still expect the current cycle to continue for 2-3 more years. The cycle is already roughly about halfway into the cycle for last 3-4 years of the positive real estate cycle that we have witnessed since 2021 onwards. But we should also note that there was a period of consolidation for the 10 years prior to that. So that is why we do think that this cycle on the positive side can also be extended, and we still can see another 2-3 years of growth in the real estate. Finally, within financialization and the financials aspect, we do like more of the capital marketplace, for the obvious reason that the market has been doing better and there has been a higher participation from the people in the capital markets, and thus all the capital marketplace like the asset gatherers, the distributors, the wealth managers, the exchanges, etc., all of them are doing well, and we are quite positive. We are also positive on the lending financials as well, for the simple reason this is one pocket of the market where the valuations has remained attractive for quite some time. So these are the pillars of our portfolio, and that's what we expect it to be over the next 3 to 5 years or so. Okay. Interesting. So I will tell you this actually. For firstly, I will give you a straightforward answer. So after a day's work, I typically look forward to a hot cup of tea or coffee along with some light snacks, and maybe after some time, a platter of fruit would be good actually. But let me tell you, usually it's not a long and tiring day simply because I enjoy the work quite a lot. What I do actually. So usually it's not a long and tiring day, but sometime it can be. Okay, any fictional character. So I will answer your question, but I will also answer a second way as well. So when I was growing up, so that time one of the most important set of the comics used to be Indrazal comics, and in those set of comics, actually I used to like Mandrake the magician the most. The other characters were Phantom, etc., because he could do a lot of things with this wave of his hand itself. But if I were to expand your question and to include historical figures, etc., also, then I would want to actually meet Bhagwan Krishna himself and to learn the lessons of life directly from Bhagwan Krishna himself.